Is the U.S. housing market about to crash? The answer you'll hear on mainstream news is a calm, reassuring no. And nationally, they're technically right. But that answer is dangerously misleading. Because while the national market isn't collapsing, in specific cities across America, the floor has already fallen out. I'm talking about markets where home prices are down double digits from their peak. Rents are in an absolute freefall. And landlords who were printing money 2 years ago are now panicking, offering months of free rent just to fill a sea of empty units. I'm not talking about a nationwide crash like 2008, but about something far more interesting: a great rebalancing. A localized collapse in the very markets that boomed the hardest during the pandemic frenzy. And in 2026, this is creating the single biggest opportunity for buyers and renters we've seen in over a decade. And that's why I'm counting down the top 10 cities where rent and home prices are collapsing, and landlords are panicking, an outlook into 2026. Stick around, because the city at number 1 is ground zero for this collapse, and the deals there are almost unbelievable. Let's get into it. At number 10 is the absolute poster child of the pandemic boom, Boise in Idaho. For 2 years, it was the hottest housing market in America. If you weren't buying in Boise, you were missing out. But the party is officially over, and the hangover is setting in. After a mind-boggling peak growth of 41.3% in 2021, home value appreciation has slammed on the brakes, falling to just 0.4% in 2025. That's not a slowdown, that's a full-blown emergency stop. And it's not over. Zillow is now forecasting a 2.2% price decline by mid-2026, and that might be optimistic. The market is still dangerously overvalued by as much as 29%, according to some models. And price cuts are hitting over a third of all listings in some surrounding counties like Gem and Boise County. And its rental market tells a fascinating story of this boom and bust cycle. During the frenzy, rents exploded, with some reports showing a 32.1% surge for a mid-size metro, one of the highest in the nation. But that very boom is what sowed the seeds of today's trouble. To meet that insane demand, developers rushed in with new supply. Now, rent growth is slowing dramatically. While some sources show a slight year-over-year increase of around 1.7%, other forecasts project a return to the historical norm of 3.5% growth by the end of 2025, a far cry from the double-digit insanity of the boom. Landlords who bought investment properties at the peak, expecting 20% annual rent hikes to continue forever, are now facing a much harsher reality. So what went wrong? Boise's problem is simple. Its meteoric rise was completely unsustainable. It became one of the most unaffordable markets in the country relative to its local median income. The wave of out-of-state buyers, mostly from California, has slowed significantly. In fact, the inflow of new residents dropped by over 60% from its peak. Now, the city is left with a housing market priced for California tech salaries, in a state where local wages simply can't keep up. The city's a market in the midst of a severe correction. For buyers, the intense fear of missing out has been replaced by the power of patience. For landlords, the days of easy money and guaranteed rent hikes are over. This is a market that is giving back some of its unrealistic gains, and that means opportunity for those who waited on the sidelines. Coming in at number 9 is Denver in Colorado. Long seen as a stable and highly desirable market, the mile-high city is now facing a significant downturn as a glut of new apartments and widespread buyer fatigue set in. Make no mistake, Denver is now officially a buyer's market. A recent analysis from Redfin found a staggering 57% more sellers than active buyers in the market. When supply swamps demand like that, prices have only one way to go: down. Denver has officially joined the list of top metros with year-over-year price declines. Homes are sitting on the market for an average of 27 days, more than double the frantic pace of just 11 days back in 2022. And price reductions are becoming the norm across the Front Range. But the real pain for investors is in the rental market. This is where the panic is palpable. The Denver rental market is seeing some of the biggest drops in the entire country. Year-over-year rents are down anywhere from 3.7% to a shocking 7%, depending on the source. One report tracking average rents by bedroom shows a mind-boggling 41% drop for a one-bedroom apartment. Why the free fall? It's a classic overbuilding, huge number of new apartment units, 18,400 last year alone, just as demand softened, creating a temporary oversupply and forcing landlords into a desperate race to the bottom. Concessions like a month or two of free rent, which were unheard of a few years ago, are now commonplace as landlords scramble to fill their empty, expensive buildings. Denver's problem is a brutal 1-2 punch. A massive oversupply of new rental units combined with a housing market that simply became too expensive for locals to afford. The shine has worn off the Front Range. Denver is a paradise right now. For renters, you have all the power. For buyers, the ball is finally in your court. Expect prices to continue softening through 2026 as this supply glut gets absorbed. At number 8, we land in our first Texas city, Dallas. While the Texas economy remains a national powerhouse, but its housing market is showing deep cracks from rampant overbuilding and sellers who are still living in the past. The warning signs are everywhere. The median closing price has dipped by over 2% year over year, but that's just the average, and it hides the real pain. The condo market is down over 8%. Even more telling, one forecast from Reventure predicts a sobering 7.8% drop in Dallas-Fort Worth home values over the next 12 months. Inventory is exploding. Active listings are up over 22% from last year, and homes are sitting on the market for an average of 89 days. That's 3 months for a home to sell. Sellers are clinging to 2021 prices in today's market, and buyers are just not having it. The rental market is feeling immense pressure from a massive construction boom. After 6 straight quarters of declining rents, the market is only just beginning to find a floor. Rents in the luxury Class A segment fell 1.8% as a staggering 32,000 new units flooded the market. While some predict a modest 1.5% rent increase by late 2025, the market is so oversupplied that it will take until 2026 or even later to fully absorb the excess inventory. The local story is simple. Atlanta does what Atlanta always does, which is to overbuild. And the same can be said for Dallas. The outlook for Dallas in 2026 is buyers have the leverage and renters have the options. This trend is set to continue well into 2026, making it a prime time for savvy negotiators. Number 7 might surprise you, San Francisco. Yes, it's still one of the most expensive cities in the world, but the ground is shifting beneath its feet. A major pullback in the tech industry is having a massive ripple effect on its housing market, creating a strange and volatile environment. SF is a unique case. Home prices have already seen significant declines, down 3.8% over the last year, according to Zillow, with forecasts for continued moderate declines into 2026. It's also one of the only major metros where rents are still below pre-pandemic levels. However, a new, chaotic dynamic is emerging. The AI boom is causing a sudden surge in demand for rentals in specific, trendy neighborhoods like Hayes Valley and south of Market. In those pockets, rents have jumped an incredible 12% to 13% year over year as AI workers flood the city. This creates a volatile, bifurcated market where the broader city is declining while a few AI hot zones are exploding. But don't let the AI hype fool you. The bigger story of SF is the story of the broader tech industry. The sector has been hemorrhaging jobs, with over 112,000 layoffs in 2025 alone. Major players with huge Bay Area footprints like Intel, Amazon, and Salesforce have cut thousands upon thousands of high-paying jobs. It's just a crisis of demand. The high-paying tech jobs that fueled SF's extreme housing costs are disappearing, creating a demand vacuum. The result is a market in a state of paralysis. Home sales volumes are at a decade low, and over 40% of active listings have had price reductions. Homeowners with sub-3% mortgage rates are locked in and refusing to sell, while would-be buyers are sitting on the sidelines. In 2026 outlook for San Francisco is, while the AI frenzy creates rental hotspots, the broader housing market is stagnating. For buyers, this paralysis means more negotiating power than they've had in years. It's a strange market, but for those who can navigate it, there are deals to be had. Rolling in at number 6 is Las Vegas. What happens in Vegas stays in Vegas, unless it's a housing correction. The city is now officially the fastest cooling market in the entire country, and the numbers are staggering. Home sales have plummeted 10.2% year over year, while the number of homes for sale has exploded by a jaw-dropping 44.8%, the largest inventory increase in the nation. This massive supply glut is pushing prices down, with Zillow forecasting a 1.2% decline heading into 2026. For landlords, Vegas is a nightmare right now. It has become a renter's paradise. Rents have fallen a staggering 13.6% from their peak, one of the largest drops in the U.S. According to Rent.com, the average rent for a one-bedroom apartment has dropped 14% in the last year alone. Landlords are feeling the squeeze as vacancies tick up and leasing activity slows down, forcing them to compete for a smaller pool of tenants. So what's happening in Sin City? It's uniquely vulnerable. The local economy is heavily dependent on tourism, which has seen a significant slump. Visitor volume was down 11.3% in June, and convention attendance has also fallen. This directly impacts jobs and consumer confidence, reducing the number of qualified buyers and renters. At the exact same time, a pandemic-fueled construction boom led to overbuilding, creating a perfect storm of more supply and less demand. The old saying is that the house always wins, but in 2026, it's the buyers and renters in Las Vegas who are holding all the cards. Expect more price drops and even better deals for renters, as this market continues to correct. At number 5, we head to Atlanta in Georgia. This market isn't just cooling, it's flashing a warning sign we haven't seen since the lead-up to the 2008 crash. Let's start with prices. Home prices in the metro Atlanta area have dropped 3.2% year over year, but that number is misleading. In the city of Atlanta proper, prices have fallen by more than 8%. Zillow is forecasting a further 1.3% decline across the metro into mid-2026, and it could be worse in the city itself. Sellers are getting very nervous. There are now 63% more sellers than buyers in the Atlanta area, and the market is so shaky that nearly 20% of all home purchase agreements are being canceled, the third highest cancellation rate in the entire country. For landlords, the situation is even more dire. Atlanta was a darling of institutional investors, but the rental market has turned into a bloodbath. Rents have plunged 13.6% from their peak, tied for one of the biggest drops in the nation. The market is severely overbuilt, particularly with industrial and multifamily properties, leading to negative absorption rates for the first time since 2011. But the real story is the one that should have your full attention. It's the investor pullback. During the boom, institutional investors flooded Atlanta, buying up thousands of homes and driving up prices for everyone. But as home prices skyrocketed far faster than rents, their profit margins, or cap rates, collapsed, falling from a healthy 8.5% in 2012 to just 5.4% today. Seeing the writing on the wall, these investors are now running for the exits at a record pace. Investor purchases have collapsed by a whooping 74% from their peak, hitting the lowest level since 2011. This behavior is eerily similar to what we saw in 2005 to 2007, just before the last crash. Investors are often called the smart money, and their mass exodus is a massive red flag that they believe the market is heading for a significant downturn. When the big money leaves the party, you know it's over. Number 4 takes us to a city with a different and perhaps more tragic story, New Orleans in Louisiana. This isn't just a post-pandemic correction. This is a market facing deep, long-term structural challenges that are causing a chronic decline. The forecasts for New Orleans are grim. Zillow predicts home values could decline by a staggering 7.1% by 2026, with some analyses suggesting the drop could be as severe as 14.54%. The rental market is also struggling immensely. The average rent has decreased by nearly 1% year over year, but some data sources show a much more dramatic picture, with one-bedroom rents down a shocking 43%. The city suffers from one of the highest housing vacancy rates in the country, a clear sign of weak demand. The city is still grappling with the devastating fallout from Hurricane Katrina, even 20 years later. It has 20,000 fewer housing units than it did before the storm, and nearly 29,000 units remain vacant. Louisiana is one of only 6 states that actually lost population over the last decade. Add in skyrocketing insurance costs due to climate risk and a fragile, tourism-dependent job market, and you have a recipe for a sustained housing downturn. There are even visible signs of decay and failed development, like the infamous abandoned Plaza Tower. This 45-story skyscraper has been sitting vacant and deteriorating for over 20 years and is now finally slated for demolition, a massive scar on the city's skyline and a symbol of its struggles. The 2026 outlook for New Orleans is challenging. This is a market where buyers and investors need to tread very carefully. Cracking our top 3 is Cape Coral in Florida. If you want to see the great Sunbelt housing correction in real time, look no further. This market is leading the entire state of Florida into a significant downturn. According to data from Cotality, Cape Coral is the #1 coolest housing market in the nation, with home prices having already fallen 6.5% year over year. This isn't a forecast. This is happening right now. It's part of what analysts are calling a massive course correction across Florida, which is now home to all 5 of the most at-risk housing markets in the country. The entire state is seeing negative price growth, but Cape Coral and its neighbors like Punta Gorda, down 6.2%, and Northport, down 4.3%, are getting hit the hardest. These were the places that saw the most explosive, unsustainable growth, and now they are correcting the fastest. Landlords who bought investment properties in 2022, expecting endless appreciation, are now facing a market where their asset values are actively falling. It's the story of the pandemic housing frenzy in place. People flocked to the Sunshine State for the lifestyle and what they thought was affordability, but prices rose too far, too fast. Now, with some of the highest inflation in the country and insurance premiums that are forcing people out of their homes, the boom has turned into a bust. Cape Coral is simply the most extreme and potent example of this statewide phenomenon. For anyone who felt priced out of the Florida dream, 2026 is your year. The correction is in full swing, and prices will likely continue to fall. This is creating the best buying opportunity in the state in years, especially for those with cash and strong negotiating skills. Our runner-up for the biggest housing collapse in America is Phoenix in Arizona. For years, it was a mirage of endless growth in the desert. Now, that mirage is evaporating, revealing a market on the verge of what one analyst is calling a mass sell-off. Home prices in Phoenix are already down 6.9% from their peak and are still falling. Reventure app forecasts that a potential 20% correction is possible if the inventory situation gets any worse. Even after the recent drops, the market is still considered 18% to 20% overvalued based on historical trends. The reason for this collapse is a massive, suffocating pileup of inventory. The number of homes for sale has hit its highest level since 2017, nearly quadrupling from the pandemic low. Sellers are panicking. Price cuts are at the highest rate in a decade, as sellers desperately try to attract a shrinking pool of buyers. If you think that's bad, the rental market is a complete disaster for landlords. Rents are down 6.2% year over year, but the real story is in the concessions. A whopping 56% of all Phoenix rental listings are offering concessions, like 1 or 2 months of free rent. That is double the national average and a clear sign of landlord desperation. The downfall of Phoenix is a perfect causal chain of overbuilding meeting disappearing demand. Developers went on an unprecedented building spree, with over 44,000 apartment units put under construction. But this new supply hit the market at the exact moment that migration reversed. Maricopa County is now experiencing net negative domestic migration for the first time since the Great Recession. To make matters worse, A long-term water shortage crisis is now halting new development in some outlying areas, adding another layer of uncertainty to the market's future. The 2026 outlook is clear. Phoenix is in a full-blown buyers and renters market. The power is completely in your hands. With inventory still rising and people leaving the county, expect prices and rents to continue their downward slide through 2026. And that brings us to number 1. The city where the housing market is collapsing harder, faster, and more spectacularly than anywhere else in America: Austin in Texas. This isn't a correction, it's a full-blown snap. And landlords aren't just panicking, they're in a state of absolute shock. No city has fallen further or faster. Home prices in Austin are already down over 20% from their peak in May 2022. Let that sink in. A home that was worth $667,000 at the peak is now struggling to sell for around $510,000. And the freefall isn't over. Real estate intelligence platform Parkle Labs predicts Austin will see the biggest downturn in the entire country over the next year, with prices falling another 16.5% from current levels. Zillow's more conservative forecast still projects a 4.2% drop by May 2026. The market is flooded. Inventory is at its highest level since 2016, and homes are sitting on the market for months, forcing sellers into massive price cuts. If the for-sale market is a disaster, the rental market is a bloodbath. Austin has seen one of the largest rent declines from its peak in the entire country, down a staggering 13.4% to 22%. Two-bedroom apartments that peaked at an average of $1,725 are now leasing for just $1,426. Why? Oversupply of new apartments. Austin built more new housing per capita than any other major metro in the country. Now the consequences are here. The apartment vacancy rate has soared to nearly 10%. Austin is the culmination of every theme we've discussed today, amplified to the extreme. It had the biggest, most frenzied pandemic boom, fueled by a massive influx of high-paid tech workers from California. It had the most aggressive and reckless overbuilding in response to that boom. And now it's facing a major tech slowdown, with companies like Intel and IBM announcing layoffs in the area, putting pressure on the very job market that fueled the mania. The result is a complete and total market reversal. The frenzy has turned to fear. It is now 34% cheaper to rent than to buy in Austin, and the power has completely shifted into the hands of tenants and homebuyers. The 2026 outlook is undeniable. Austin is ground zero. It's, without a doubt, the #1 city in America to be a renter or a homebuyer in 2026. The deals are already incredible, and they're only going to get better as this market finds its bottom. So there you have it. The pandemic boomtowns are going bust. This isn't a nationwide crisis like 2008, but a brutal, localized correction concentrated in the Sun Belt and other overheated markets. But this shift is about more than just lower prices. It's about a fundamental change in the power dynamic. For years, landlords and sellers held all the cards due to chronic housing shortages. This allowed them to charge exorbitant rents, demand outrageous prices, and tack on all sorts of junk fees with little resistance. Now that's changing. The current market shift, with rising vacancies and desperate sellers, is giving leverage back to tenants and buyers. This market pressure is being amplified by a new wave of pro-tenant legislation in states like California and Colorado, which are moving to ban junk fees and increase transparency in rental agreements. The famous investor Robert Kiyosaki once said, "The problem with real estate is that it's local." He couldn't be more right. And locally, in these 10 cities, the deals are officially back. For the first time in a long time, you, the renter and the buyer, are in the driver's seat. But what's happening in your city? Are you seeing prices drop? Are landlords getting desperate? Let me know in the comments below. I read every single one. If you got value from this video, do me a favor and hit that like button and subscribe for more analysis you won't get anywhere else. Thanks for watching, and I'll see you in the next video.